Hey, what's up guys? This is Ezekiel here. So, you know something? Most people are using the ATR indicator the wrong way. They think that it's just about the strength of the ATR. So for example, if the ATR is going up, it means that, oh, the market is strong. And if it's going down, it means that there's weak strength in the market. But there is so much more to it. So the ATR, for one thing, allows you to spot like really big moves right before it happens. So this itself will make you a lot of money. So as we know, right, the trend is your friend, but you need to know when will it reverse. And this important tool has a formula that you can unlock to tell you exactly when the pair will likely reverse and how you can capitalize on it, right? And not just that, right? It is a really good stop loss tool for you to increase your win rate. Okay, so first off, what is the ATR? The ATR, or the average true range indicator, isn't just some like random line sitting on your chart. It's like your personal volatility radar. So the purpose of the ATR is to tell you how much the market actually moves and how volatile the market is right now. So with this knowledge, you are able to catch like explosive moves. You are able to skip weak setups. You are able to place stop loss that doesn't get hunted. If you just take a look at the number at the corner, right? That is like the market heartbeat. It shows you the average range of price movement over the last few candles, right? So this number shows you how many pips that the market has moved on average over the last 14 candles, right? So you can tweak the number, right? Whether is it 14 in the settings if you want, but hey, I will just stick with the default itself. Let's say the average of the last 14 candles, let's say, is 60 pips. So if the number goes higher, it means that the market is getting more volatile. If it drops lower, the market is coming down. Disclaimers: the ATR doesn't show which direction the trend is moving. Even if the ATR is going up, it doesn't mean that the price is trending upwards. It just what? It just measures the market volatility, right? Not the trend direction. So ATR gets its name because it's literally average of all the true range values over that set number of candles, bars, or whatever you use, right? If you use the true range of say 20 candles and then you add them up, right? And then you divide it by 20, right? That's where you get the 20 period ATR. Here's the simple logic. When the candles on the chart starts getting bigger, meaning what? The highs and the lows are now further apart. So the ATR goes up, right? So this tells you that the market is getting more active, making bigger moves. And if the candle starts getting smaller, price is not moving so much, the ATR will drop as well. This is because the ATR measures the volatility of the market. So when things slow down, it shows calmer market. It's as simple as that. All right. So now, once you understand this, you basically got the ATR figured out, right? It just tells you how much the market moves, right? Nothing more, nothing less, right? The more movement there are in the market, the ATR goes up. The less movement there in the market, the ATR goes down, right? That's it, right? So now that you know how the ATR works, we can now put the ATR to good use the pro way. If you want to use the ATR to catch like explosive moves before they happen, you first need to understand how the market really moves. The market doesn't move in straight line. It moves in waves. It always cool off at some point. So after like a strong push, the traders will start taking profit. So the volatility will then drop. So the things will then slow down. But that's not the end. It's just like market recharging for the next big move, right? So the ATR helps you to spot. So if you're looking for a trusted platform, let me give you an honest recommendation. So this is the one that I've tried out and was left like positively impressed. It's Okta. So Okta is an award-winning app trusted by 40 million users. So they have been in the market for over 13 years. They cover like 180 plus countries and are fully licensed. So what is also really important is that they offer instant withdrawals. It's like crazy, right? And they have some of the lowest spreads, zero commissions, and no swaps. So as traders, it is also important to know that our funds are secure, right? So apart from having full compliance to safeguard clients' data and funds, Okta further does this by having separate trust accounts for client funds. And they also have 24/7 customer support. So now, here's the thing that really impressed me. They have this AI generated chart patterns like this, right? And that's like super cool and super helpful in today's world, right? So click on the link below in the description box and download the Okta app. You're gonna love it like I did. Those quiet movements, right, which is like the calm before the storm. When volatility is at its lowest, that is your signal that what? Something big is coming. So the real question is, will you be ready? Okay, so if you want to catch the big moves before they happen, start watching for the silence, right? The market don't explode out of nowhere. They build pressure. So low volatility means what? The traders are waiting, the orders are stacking, right? The energy is loading. So when the ATR hits, for example, a multi-year low, say on the higher time frame chart, like the weekly chart, for example, the market may look like it's asleep, but not for long. We don't want to chase the breakout like most traders out there. What we do is we can position ourselves before the normal traders take the trade when it runs, right? We position ourselves right before the market goes. Spot the quiet phase, mark your key levels, and be ready. That when the market wakes up, you are already ahead of the game. This low volatility period, it means what? A big move is coming away, a larger trend, or a wave that you can catch and ride. Let's take a look at this example. On the weekly chart, you will notice that the ATR line is dropping down to a multi-year low, right? So when the ATR is at a multiple year low, the market is like too quiet. Exactly when you should now pay attention. The quiet markets, they don't stay quiet forever. Think of it like pressure cooker. The low volatility is the market building up energy. When it finally breaks, it explodes. So that's where the most money are being made. Here's what you do. First of all, spot the key support and resistance level. Then watch for a breakout, right? Not just like a small move, but like a real push. When this happens, you want to trade in that direction. Because once the market wakes up, it moves fast. So a low ATR is not a signal for you to sit back, relax, the market is not doing anything right now. So no. It is a warning sign that something big is coming. Be ready. For example, when you spot a breakout on the weekly chart, that's good. But don't just jump in. Zoom in to the next time frame downwards, which is the daily time frame. Zoom into the daily chart to fine-tune your entry. There are two things that you can trade with. First one is a bear flag. So when you see a bear flag, this is a continuation signal. It means what? The momentum is still strong. Or in the downtrend, when price goes up and hits the resistance, watch for the rejection area. It is an entry signal itself. It's not about chasing the price. It's about positioning yourself early in a high probability setup. You find the structure, time your entry, and then you ride the bigger trend with confidence. Keep an eye on the weekly ATR. So when the volatility is at the rock bottom, on the higher time frame, it means that the big move is on the way. The market is not dead, it is gearing up. When it breaks, it's going to be a big move. Focus where the other traders are not looking. That's how you stay one step ahead of the crowd itself. Okay? Good. The market has its limits. So it can only stretch so far before it snaps back. So what? That's where the ATR comes in, right? It tells you exactly when the price has gone too far. That's the thing. If price, take note, moves 1.5 times its average ATR into a major, for example, support or resistance zone, right? It's like a runner who is hitting exhaustion. It cannot keep going forever, right? So that's where we, as smart traders, we start preparing for a reversal instead of chasing the move, right? So at this point, the price is now overstretched. Momentum is slowing down and a pullback is very likely. So if you're watching closely, this is now your shot, your turn, right? To catch this move back upwards. backwards, right? Right before it happens. Every vehicle, whether you are trading Forex, stocks, crypto, commodities, right, has a normal range, right, that it moves within. Whether that's the daily range, the weekly, the monthly range, for example, when price stretches 1.5 times beyond average ATR, and then it's smashed into, for example, the support level or the resistance level, it's like you run an engine that you are pushing it too hard. It's bound to break down, it's bound to stall, right? So that is where the reversal usually happens. Not because like, oh, you got lucky, right? You got lucky, you got in right smack at the lowest point, at the reversal point. No, it's more than luck, right? It's more than luck. It went right into a key resistance level. That's not just we are trading price action. That's also understanding that the market is now exhausted. If you see a bearish signal, which is where all the candlestick patterns can come in, right? Like a shooting star candle, right? That is your cue. The market isn't just moving faster. It's now overextended, right? So when the price stretch too far, too fast, a snapback is usually going to happen. Here's an example. Bearish candle, strong drop. And then the move just hit what? 1.5 times the ATR. So what does this tell you? That there's going to be a high chance of reversal. So that's where we as smart traders right now, we don't chase the downtrend. I better get in before it goes down further. No. This is where you can use the ATR to spot where the market is like gas out and then position yourself. For example, let's say probably it's time to take TP if you were selling earlier. Probably it's time to trail it, prevent it from reversing. Take a look at this example. If say this pair normally move say 350, 375 to 400 points or pips in a month. Suddenly, right now, it's surged to over 650 pips. That is 1.5 times its normal range. So this is a what? This is a clear sign that the market is overheated. Alright, so now we jump to the weekly chart. Price has now hit a major support level, right? It doesn't just gonna store there, it's going to bounce and close higher the following week itself. Three things are happening here. Number one is an overextended move. The market has gone too far, too fast, right? Number two, there's a key level of rejection, right? It's testing a major support zone. And then number three, you got a bullish close, right? That's where it's a confirmation that the buyers are now stepping in, right? So that's where when you put all these three together, maybe it's not just like noise, it's a high probability reversal setup staring at you right now in your face. Most traders, they set their stop loss right at an obvious high or an obvious low. It's almost basically handing your money over to the market itself. So we know better. Price, it often dips just enough to trigger all those stop losses before reversing into the direction that you expected. So instead of placing your stop loss like everyone else, give it some breathing room. Set it what? Slightly beyond the usual zones. Right where the weak hands, they get taken out, but you are staying in trade. Stop placing your stop loss right at support or resistance level. It is like one of the easiest way to get taken out. Here's the thing, right? The market don't move in perfect lines, right? They move in what? In zones. So price tend to bounce around the area. So if you place your stop loss right at an obvious level, the market makers are easily going to stop 90% of traders out there. So instead, give your trade a little bit of space. Set your stop loss just beyond where most traders get shaken out. This way, the market can do its thing without hitting your stop loss and kicking you out before the real move actually happens. So a lot of traders, they stick with a fixed stop loss because it's straightforward. But that doesn't mean it is effective all the time. For example, if the average daily move for a pair, say it's 75 pips, it makes more sense to base your stop loss on that than just to use a random fixed number, right? So if you look at this example, it has an ATR of about 180 pips. So you see how low is that, right? It's a sign that a big move could be coming soon, right? So different pairs, different vehicles, different levels of volatility. So the numbers are different, right? So using the same fixed stop loss, every pair, everywhere is not going to work, right? Your stop loss position should be adjusted based on the time frame that you're trading. Shorter time frame have smaller ATR values, right? Which means what? Tighter stops. If you're trading the 1 hour time frame and you use the daily ATR, that's too big. That's too big. It's not the right fit. Skip the fixed stop loss, here's what you do. Start by mapping out where are the key support and resistance level. Then you place your stop loss about 1 to 2 ATR beyond those zones, right? Not specific level, zones. So this gives your trade room to move without taking on unnecessary risks. Tighter stop means more stress, more stop out. Smarter stop loss means more wins, more control. Let me show you some examples. You see a bearish engulfing pattern. So it looks like what? It looks like a perfect place to go short. But here's where most traders get it wrong. They place their stop loss right above the recent swing high. They think that is safe. But that's exactly where the market love to grab volatility before turning around. So instead, give your stop some space. Set it a bit higher. Set it past the obvious level, right? That way you're not an easy target. You are the one that's going to be still in the trade while others gets knocked out. You've seen it happen, right? The stop loss get hit, right? And right after that, the market moves exactly how you plan it to be. Let me give you some specific example. The recent high, 170.5, the level. The ATR for the last few bars, right, is 100 pips. So you don't put your stop loss right above the level of 170.5. Instead, give it some breathing room. You add the ATR to the high, so which is 170.5 plus the 100 pips. So that would equals to 171.5. That is where the stop loss should be. Right? So this way, when the market makes a normal move before heading your way, you're still in the trade and not getting shaken out. First off, we talk about what? We talk about how to identify a massive breakout, right? So when volatility is low, this is how you are able to identify a massive breakout. You can do this beforehand or do this afterhand, for example. Afterhand means what? You see the breakout, you check back the volatility in the higher time frame. Or you see the volatility, you get ready to set yourself out for a breakout. Next, when the breakout happens, when you see the market keeps going and the breakout happens, eventually it's going to stop, right? That's where you want to know where would it stop. So that's where you use the 1.5 times ATR. When price goes into a key level, not just randomly, oh, it's 1.5 times, I better time it to reverse it. No. It needs to hit a key support level, your win rate, your probability, plus price action over there. That's where the market is exhausted. That's the best time to go for an entry. And then you want to see, okay, now you have timed all your entries right. You want to see where to set smarter stop loss using the ATR itself. Not at the obvious high or obvious low, but using the ATR itself. Alright, so now it's the obvious thing to do now. It's time to add the ATR into your chart and apply what you have learned. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.